What's up, YouTube? Just coming at you with another video. Want to do kind of a follow-up video to my price to earnings ratio explain video because I noticed that it was 19 minutes and 22 seconds long, which is kind of long for the price to earnings ratio, but it is pretty in-depth video if you want to go watch it. But I also wanted to offer you guys kind of an abridged version or a quick down and dirty version of it so that I can kind of teach you the things in a lot quicker manner without having to go so in-depth and everything. So let's go ahead and get started and dive into it and learn a little bit about the price to earnings ratio. So let me pull up. This is Finvizcom, one of the resources that I use quite often for looking for stocks and stuff like that and kind of monitoring them. I'll go ahead and pull up an example here. I'll pull up Apple, which is AAPL. So for the price to earnings ratio, the way it's calculated is you take the price of the stock here and it is divided by the earnings per share, and that gives you, so the earnings per share here is 11.85. So 11.85 is divided into 299.15, which brings you to a price to earnings ratio of 25.09. What this essentially tells you is that you're paying $25.09 for every $1 of earnings. So it kind of gives you an overall understanding over a period of time how much money you're paying relative to an asset's productivity or ability to generate income. So that's kind of what it gives you so that you can understand whether you're paying a little too much, a little too less, whether it's cheap or expensive. And you can also use this across different industries and across different stocks within the same industry. So you can also compare Apple against Microsoft. Let me pull up Microsoft, which is MSFT. So 158.51 is the price right up here, and divide that by 5, which gives you a price to earnings ratio of 31.76. So a little bit more expensive than Apple, but they might be in a couple different businesses. Obviously, some of these that used to be more product oriented or consumer product type companies are more turning towards services because they're noticing that it's a higher margin business. So that could be another reason why that we're seeing these price to earnings ratios going up. It also can be a macro effect with the overall market going up, so these other larger cap stocks going up because everybody's investing more money. It can be a multitude of different things that I can show you. I just want to show you a couple more things here on the price to earnings ratio. I'll go to another website that I use. Type in bigcharts.com. So you type it into Google and go down here to Big Charts, which is a component of MarketWatch.com, one of the services that they offer. Type in AAPL for Apple and hit Advanced Chart. Once Advanced Chart comes up, you can see that we have some different things that we can play with along the side here. So what I'm trying to do here is let's pick the 1 decade so that I can show you over a longer period of time how the price to earnings ratio can move up or down depending on what's going on in their industry, within their company, stuff like that. So I picked 1 decade, come down here to indicators, and as you can see down here they already have the default one set at volume. So I want to reset that to PE ratio, which is down here. So we'll go ahead and select that and select draw chart. And so that brings us to this chart that goes over a period of 1 decade or 10 years. And so you can see this is right before 2011, so right about 2010. And you can see that the price to earnings ratio has come down steadily over time, then it kind of flattened out and plateaued. Now it's moving up again, which could possibly be because they have this strategy of moving more towards services, which is a larger margin business, and therefore people are more willing to invest at a higher price in the stock because they're expecting the earnings to grow. Even though they're such a massive company, they're expecting their earnings to grow because they're moving towards a higher margin business that could possibly yield them more revenue. So just something that you can, another resource you can use, like I said, bigcharts.com, a component of MarketWatch that can show you over a long period of time how it's played out in terms of the PE ratio. Let me show you one more thing, all data, see how far back it goes so that we can see over a long period of time. And as you can see here, you may have to zoom in a little bit like I did with the decade view because it can be quite wild over a long period of time, especially if you go back towards like 94 when they were still a newer company. The price to earnings ratio can be all over the place because they're still a new company. They may be growing fast, so that may be going up or down super quickly, but it doesn't go up and down as much when it becomes a more mature company. So that gives you just a good understanding of how to look at it over a longer period of time. One of the other things that I'll go over real quickly that I mentioned in the other video was how that this ratio can be manipulated so that you understand that before trying to use it for different things. So I'll go back to Finviz and type in Apple again. And so as we talked about how it's calculated, it's based on earnings per share. And so earnings per share is determined by, it is the earnings. So it's basically just the earnings. So this is trailing 12 months earnings divided by shares outstanding. So Apple has 4.49 billion shares. So that's divided into, to give you a number of how much they earn per each share of stock. And so one of the things that this can be manipulated, because obviously this is a component to calculate price to earnings ratio, is if there's a stock buyback, it will lower the amount of shares outstanding, which means that the earnings per share will go up, and it will distort this price to earnings ratio to make it look like it's a cheaper stock. So this may, if they repurchase shares and lower the share float or the shares outstanding in the public, it will lower this from 4.49 billion. Let's say they lower it to like 3 billion because they repurchased so many shares. It will ultimately force this number up the earnings per share number, and then will bring this price to earnings ratio down to make it look like you're getting a cheaper, getting it at a cheaper price, which you are, but at the same time, you need to understand why it looks like a cheaper price, because some people may see that the price to earnings ratio went down and can make the conclusion that maybe it's because earnings went up, but in actuality it was because they repurchased shares and nothing happened to earnings. So that's one thing you want to watch out for. I'll pull up one more thing that I showed in the other video that I think is important. It's on Investopedia.com if you've ever heard of it. But we'll type in, it was an article that they came out with about the price to earnings ratio and how it can be manipulated. And so just a good way to understand it. Let me pull it up here. All right, how the price to earnings ratio can be manipulated. So we'll pull this up and we'll come down to here, wherever it's at. Price to earnings, lead investors. It was. Let me type in something else, possibly. Convince lead investors there's no more way to calculate. Okay. Let me check to see if it's on somewhere else. There we go. All right, so this is another thing to watch out for is debt. So when you're comparing especially price to earnings ratios industry to industry, especially if you're looking at like something like General Motors or something with a high cost of doing business, where essentially they have to borrow a lot of money to keep their business going because it's such a capital intensive business. You may not be getting the right view, or you may not be seeing the price to earnings ratio as it is based on the risk that you're taking. So it may look like lower if you use a traditional way of calculating it, because debt can ultimately inflate the earnings numbers to make them look higher than they are, when in actuality they're taking on more risks to get those numbers, so it's not risk adjusted. So something to look out for. They talk about here in the article on Investopedia about possibly using enterprise value as a way to recalculate it, because that brings in the assumption of using debt and adding that onto the calculation so that it is accounting for that. So it's something to watch out for, but again, just wanted to give a quick down and dirty understanding of the price to earnings ratio. You can also go look and watch the 20-minute video that I put out, but wanted to give you a quick, short, abridged version so that if you don't feel like watching the 20-minute version, you don't have to. So thanks for watching. Stay tuned for my next video, and subscribe if you like this. Let me know down in the comment section if there's anything else that you want me to produce. Thanks again.